Hello, everyone. Welcome to Understanding the Basics of 1031 Exchanges by Overland Capital. My name is Michael Holman, and I'll be your host today. I also have Ken with me. Say hello, Ken.
Hi, everybody. It's great to be here. Excited to be a part of this presentation.
Thank you. We appreciate you being here. So let's go ahead and look at the schedule for today. So after today, we want to make sure that you have the confidence to walk away from this webinar and go have an intelligent conversation about 1031 exchanges really with anyone. So whether you've done a 1031 in the past, are looking to do one in the near future, or just want to learn today, should be full of great insight on the topic. A couple of quick housekeeping items. Make sure you stick around to the end of the presentation in order to take the poll and get your questions answered during the Q&A. That's right, we'll have a live Q&A where Ken and I will answer all your questions. You'll get a copy of this presentation, but you can also view it on our website at overlandcapitalcorp.com and by going to the education tab there. So lastly, we just want to make it clear that we're not acting as tax advisors or attorneys. So please make sure you consult your own experts when actually doing a 1031 exchange. This webinar is for educational purposes only. So I'm going to go turn it over to Ken to introduce himself.
Great. Thanks, Mike. Appreciate that. I have to admit that I'm the senior citizen of our group. I've been around for a long time and done a ton of transactions, but just to hit a few of the highlights of who I am and what I do. I'm president of Overland Capital, and our parent company, Overland Group, Inc., and the affiliated companies that make up our family of entities. And I'm also the founder and president of the National Association of Real Estate Advisors. We affectionately call that NARIA. And we offer a commercial real estate designation called the Certified Commercial Advisor, CCA. I have a degree in accounting and an MBA. I've been to law school. I hold several of the top real estate designations, including CCIM, CPM, CCA, which is our designation, and the CRS. And I absolutely love working in this industry. Especially, I enjoy working with two of my sons, Dave and Mike, and many of our wonderful qualified associates that we have in the company. So let me turn it back over to Mike to introduce himself and tell a little bit about the company.
Thanks, Ken. So I've been at Overland Group for a couple of years now, and my role here is to ensure that our projects are effectively financed. So basically, I work with investors and lenders to make sure that each project is on schedule and optimally structured. In addition to that, I oversee all financial and investor reporting, both internally and externally. So before joining Overland, I was with Ernst & Young in their assurance practice. While there, I spent most of my time in the real estate technology industries. I'm a licensed CPA as well. So just a quick overview on Overland Capital. Overland Capital has been around for a while now and is part of the Overland Group family. Overland Capital's main role in the Overland Group is to raise equity capital for development and acquisition products. Our latest project was Coyote Creek Apartments. Some of you might have seen that come up. That was in southern Utah, where us and our partners raised $6 million in equity capital for that project. While doing this, we've really found an even better and higher purpose for Overland Capital, though, and that is to provide capital partners really a better investing experience. One of the main ways we do that is we try and give our investors the confidence they need to navigate the world of commercial real estate investing. So these webinars are just one of the ways where we're trying to provide that confidence to investors. As I mentioned earlier, Overland Capital is part of Overland Group. Overland Group has been around for over 30 years and is a fully integrated real estate company. What that means is that we are capable of handling almost every piece of the real estate puzzle, which is key to our model. We find that by controlling most of the pieces, we can keep costs down as well as ensure that construction, development, capital, and management are all working towards the same goals. I'm going to go ahead and turn it over to Ken, though, to get more into 1031s now.
So we have done a ton of 1031 deals. That last project that Mike mentioned, the 116 unit Coyote Creek project, we brought in 6 1031s as part of that deal. But the 1031 tax deferred exchanges, they've been around for a long time, since Congress passed the Revenue Act of 1921. They seem to have gotten more play in recent years than they have in the past, but the actual law is found in Title 26, U.S. Code, Section 1031 of the Internal Revenue Code. And under that Section 1031, the law specifically states that a taxpayer may defer recognition of capital gains and related federal income tax liability on the exchange of certain types of property. And these transactions are known as 1031 tax-deferred exchanges. 1031 exchanges are an excellent wealth-building strategy because they leave you with more money to invest in bigger and better properties. So I'd like to note that, however, that tax liability is not eliminated, it's only deferred. So let's review a few of the basic steps in doing a 1031 exchange. So step one, you need to decide up front that you're going to do a 1031 exchange. The window for identifying a replacement property is relatively short, so making the decision before you sell your property is pretty important. You don't have to do it before, but it's just a good idea. You should also determine who you want to use as a qualified intermediary. They're called exchangers, and that's the person or company that you're going to use to help you through the 1031 process. Most title companies are affiliated with a qualified intermediary. And step two, after you've found some potential properties you may want to purchase, that's probably a good time to put your property up for sale. And the property you're selling is called the relinquished property, and the property that you're buying is called the replacement property. We'll use those terms quite a bit in this presentation today. So step three is to identify the replacement properties and put them under contract. You can have more than one replacement property that you identify. You only have 45 days to identify up to 3 replacement properties. You can even identify more than that, but we'll show that a little later on. But the clock starts ticking the day you close on the sale of your property. And then step 4, you close on the purchase of the replacement property. Then you have, within that time frame of when you sold your property and you buy the new property, you have 180 days. And you have to do your 1031 exchange within that time frame. These are calendar days, and they include weekends and holidays. So if you haven't identified the replacement property within 45 days, or you haven't closed on the sale of the replacement property within 180 days, your 1031 exchange is disqualified. And what that means is you wind up paying the taxes on the sale. There are a few important 1031 exchange rules that you must follow. I've found that the IRS absolutely loves rules. So don't worry too much about the tax code, but you do have some latitude within the tax code to be a little creative. But there are 3 things that you should remember when you're doing a 1031 exchange. So 1, the title to the old property and the title to the new property must be the same. The owner on title cannot change. For instance, if title is in your personal name, you can't acquire the new property in the name of an LLC or some other person. And 2, all the proceeds must be reinvested. Now, when I say all the proceeds, that's a little qualified. You can deduct real estate commissions, title and escrow fees, and any exchange fees that you incur from the amount that you need to reinvest in the replacement property. And any proceeds you take out at the time of the sale, except for the payment of those fees, you'll wind up getting taxed on. Then 3, both the old property and the relinquished property, they must be held for investment. That's an important term. You can't use the proceeds from the 1031 exchange to buy a new primary residence or a vacation home. Those are not considered held for investment, and they're disqualified transactions. So let's drill down on this point just a little further. The phrase held for investment means any property that is acquired and held for income production, meaning they're for rent or for lease, or for growth in value, which obviously means capital appreciation in the value of the asset. So both the relinquished property and the replacement property must be held for investment or for another term which is called productive use in a trade or business, which relates to your business. So the law states no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind. So there's another catchphrase that's important. The term like kind. And what that means is it's basically defined as real property exchanged for real property. In other words, you can't exchange a rental home for a yacht or some other item that isn't considered real property. Properties are considered like kind if they're of the same nature or character, even if they differ in grade or quality. Properties are also considered like kind if they are of a like class. So trade a duplex for a duplex, that's a like class, something like that. But most legal scholars interpret the term like kind just as meaning replacing one real estate investment property for another real estate investment property. So you could replace, say, a single family rental home with a duplex or land, or even an office building or a retail property or an industrial property. Those can all be traded back and forth as long as you intend to hold the replacement property for investment. You can even exchange property that you've held in your business for investment property or vice versa. Another important requirement is that the replacement property must be of equal or greater value than the relinquished property sold. So what does that mean exactly? Well, basically it means that the replacement property must be worth as much as or more than the property you just sold. If it isn't, there's likely going to be a tax consequence requiring you to pay at least the portion of capital gains tax required on the sale. So let's run through a quick example. Say you sold a single family rental home for $250,000 and purchased a duplex for $300,000. No problem. Perfect 1031 exchange because the replacement property has a greater value than the relinquished property. On the other hand, if you sold the rental home for $300,000, or say you sold the rental home for $300,000 and you bought a duplex for $250,000, well, you'd be required to pay the gain cap, and you'd be required to recognize the gain and pay the capital gains taxes on at least $50,000 because the replacement property was not equal to or greater than the replacement property. Now I'm going to turn it over to Mike for a few things.
Thanks, Ken. There is a couple of deadlines that you need to understand with 1031 exchanges. So those deadlines are the identification of a property and purchase of a property. So Ken will go into all of the identification rules in a few minutes. But before that, we need to understand the time frame the IRS requires. So when doing a 1031 exchange, you must identify a replacement property within 45 days of the sale of the 1031 exchange property. You must purchase a replacement property within 180 days of the sale of the 1031 exchange property. So when doing a 1031 exchange, circle those dates in your calendar. The IRS isn't very forgiving to those who miss those dates on their 1031 exchanges. Now, let's run through an example. So this example is without doing a 1031 exchange. And it's important for us to understand this so we can see the benefit of doing a 1031 exchange. I want to give a fair warning to everybody that there are a lot of numbers you're about to see on the screen, but don't worry. We're going to walk through each number so that you can understand what's going on here. Remember, if you have questions, type them in the Q&A and we'll answer them at the end of the presentation. So when running through this example, there's 3 separate numbers we need to calculate. The first is the adjusted basis. The second is the capital gain from appreciation, and the third is the net sale proceeds. So let's say you bought a rental home for $200,000 5 years ago. The land was worth $20,000, and the actual building was worth $180,000. You can't depreciate land, but you can depreciate the $180,000 building over 27 and a half years, which is the IRS rule. So that depreciation number is simply $180,000 divided by 27.5 times 5 years. So subtracting depreciation from the total cost of the rental home gives you your adjusted basis at sale. Next, you decide that you're sick of being a landlord and you sell the property for $250,000. Now, we need to subtract the projected cost of the sale, aka real estate commissions and closing costs, and the adjusted basis we just calculated above. That gives us our gain on sale. We already calculated depreciation above, so we know that $32,727 of that gain is related to depreciation. So the difference is attributed to appreciation. Just like magic, we now have our capital gain from appreciation. All right, everyone, we're on the home stretch, so stick with me here. Now time to calculate the net sale proceeds. This is the fun part because this is how much cash you actually get from selling that rental property. We start with our sale price of $250,000, and once again subtract real estate commissions and closing costs of $15,000, which gives us our sale proceeds before tax. Now we subtract our payments to Uncle Sam. He's going to tax you around 25% of the depreciation you took and roughly 15% of the gain attributable to appreciation. Whew, that was the process. But finally, we have our net sale proceeds of $221,568. Now, obviously, you're a savvy investor, so you take that cash and reinvest it. A quick side note here, though. Notice that there are 2 types of gain associated with the sale of real property. You have gain attributable to depreciation and gain attributable to appreciation. Since the IRS permits you to depreciate real property over its useful life, and that amount gets deducted from the income you're required to report, when you sell the property, you better believe the government wants you to pay taxes on the depreciation you were permitted to take. So the tax rate on depreciation recapture is 25%, and the tax rate on gain attributable to appreciation, usually around 15%, depending on your tax bracket. Okay, finally, we're to the point that I'm trying to make with 1031 exchanges. In this example, if you decided to do a 1031 exchange, then you wouldn't have to pay the taxes highlighted. And that could be part of your reinvestment money. Remember, you're a savvy investor and you reinvest that money. So you were able to take that money along with the other cash available and invest it in a new property rather than paying Uncle Sam. So those dollars can work for you, earning a greater return. I'll save you from any more math, but if you did a 1031 exchange on this property and earned 10% on your money, then over the next 10 years, you will have $36,361 more dollars than if you didn't do a 1031 exchange and just paid Uncle Sam. So Another thing to consider when dealing with 1031 exchange transactions is the debt associated with the sale. If it's an all-cash transaction, then you don't have to worry about dealing with debt, and that was like in the example we just did. If you have debt, meaning a mortgage on the property you sold, to fully defer all capital gains, both the equity and the debt in the new replacement property must be equal to or greater than the equity and debt of the sold property. So we're not going to get into this any deeper on this webinar, but basically there's just a few more steps that need to be taken. We just helped 4 people with their 1031 exchanges, investors with debt, get into our Coyote Creek project. So we might do another webinar at a later date that goes more in depth here, but for this webinar, we feel like that's sufficient. So this is going to bring me to my next point. 1031 exchanges are complicated enough that you shouldn't attempt to do these without having expert guidance. Almost every 1031 exchange is handled by a qualified intermediary. Qualified intermediary is also known as an accommodator or an exchanger. So this is a company approved by the IRS who is qualified to facilitate 1031 tax-deferred exchange transactions. Make sure you or your client uses a non-related qualified intermediary when doing a 1031 exchange. So I'm going to give it back to Ken now.
So Mike makes it sound like numbers are a big deal for him. He's a CPA. He loves these numbers. So thanks, Mike. The IRS, they placed a number of restrictions on how many properties you can identify as potential replacement properties. Because it's possible to have a sale fall through, then before you can purchase it, then that's why they permit you to have more than one property. But you can identify not only more than one property, but as long as you meet certain rules, you can do a number of properties. So the 3 primary rules we're going to discuss are these: the 3 property rule, the 200% rule, and the 95% rule. As you work with your qualified intermediary, these selection and identification rules will come into play. You don't have to worry too much about them at this stage, but you don't need to follow all 3 rules simultaneously. Under the 3 property rule, the IRS permits you to identify up to 3 properties regardless of their fair market value. All identified properties are not required to be purchased to satisfy the exchange, only the number of properties needed to satisfy the value requirement. So each of the properties you identify could be of equal or greater value or not. They don't have to be of equal or greater value. But at the end of the day, the properties that you purchased must in total be of equal or greater value than the relinquished property. The 200% rule states that any number of properties may be specified as long as the aggregate fair market value of all the replacement properties does not exceed 200% of the aggregate fair market value of all the relinquished properties as of the initial transfer date. And the third one is the 95% rule, which states that any number of replacement properties can be identified as long as the fair market value of the properties actually received by the end of the exchange is at least 95% of the aggregate fair market value of all the potential replacement properties identified. So each of these rules are exclusive from one another. Most taxpayers use the 3 property rule because it's generally the simplest to understand. That way, by identifying 1, 2, or 3 properties, you might consider acquiring. So, however, if a taxpayer has identified more than 3 properties, they can choose to identify under the 200% rule. If the 95% rule is selected, the taxpayer still has to identify the properties within the 45-day window but they can determine the fair market value up to the day of closing or by the 180th day of the exchange period, whichever comes first. So as I said, to eliminate a lot of confusion between these various rules, most people just try to comply with the 3-property rule, unless they have identified more than 3 properties, in which case it gets a little bit more complicated, but that's usually resolved with some guidance from your qualified intermediary. The documents required are pretty simple. They're almost like any other real estate transaction you'd do. There's a standard real estate purchase contract. Some people call it a purchase and sale agreement, and the various addendums that usually accompany these types of real estate transactions. Often there's one additional addendum that's usually included in a 1031 exchange. That's called the 1031 exchange addendum, where both parties agree to participate in a 1031 exchange. You don't want to get in a situation where you've decided to do a 1031 exchange and you've identified a property and the seller of the other property doesn't agree to participate with you in the 1031 exchange. So that's why they have that addendum. If there's a mortgage or a promissory note on the property, then you'll be dealing with both the promissory note and a trust deed. But that about sums it up for understanding the basics of 1031 exchanges. Mike, would you like to do anything would you like to wrap this up for us?
Sure. All right. Wow. We have covered a lot of topics in a short period of time. So we want to make sure that you have a very quick recap. Okay. On your screen, you're going to see a lot of details, but the basic steps to a 1031 exchange are: 1, sell a property; 2, identify a like-kind exchange property of equal or greater value within 45 days; 3, purchase the property within 180 days; 4, save tons of money on taxes. Okay. So some of you out there might be thinking to yourselves, man, 1031 exchanges seem like a lot of work, and are they really worth the trouble? So I'm here to tell you the answer is a resounding yes. Okay. We used a similar example with rental homes, but now we're going to amp that up to deals like Overland Capital does on a regular basis. So let's say you sold a couple of rental homes worth $500,000 and are trying to decide if you want to just pay taxes of $100,000 or do a 1031 exchange. You ultimately decide the right thing and you do a 1031 exchange. Let's say you come into one of our apartment development projects. The average IRR on those projects are usually around 15 to 20%. Our last deal, Coyote Creek Apartments, was at 19%. So let's just use that as an example. So you come into a deal like that for $500,000 on a 1031 exchange, earning 19% IRR over a 5-year period, you're going to have $256,000 more dollars. That's over 50% of the money you put into the project. Now, in 5 years, when that project is sold, you can take all of that extra money and do another 1031 exchange. Okay, so now at that point, any of you who are asking that question to yourselves, I want you to now ask me, you tell me if a 1031 exchange is worth it. I mean, that's huge savings. And honestly, some of our investors have deferred the payment of taxes for years now and have deferred hundreds of thousands of dollars in taxes. So these people are now investing huge sums of money into our projects. And that's it, folks. So thanks for joining us today. Please make sure you take the poll that pops up on your screens, as this helps us to get to know you better. And we're going to go ahead and get the Q&A started as well. So Mike, once again, yeah.
Mike, let me jump in here while we've got a couple minutes while people are answering the poll and putting up any questions that they might have. But
yeah,
I thought it might be kind of fun to run through the coyote just project when you don't and which product they want to get rid of and or they want to sell and they want to come into a bigger, nicer development that has more upside potential for them. So what they do is they would purchase an ownership interest in the land that we have, and they become a co-owner with us on the land. We bring them in on that basis, and then as the project gets developed and going forward, then we're in a position where we roll them into as a full-blown investor in the entire project. So it's pretty cool for them to be able to participate in that regard. And we have a couple that I think would work that way. But anyway, that just gives you a little idea of how those projects usually work.
Yeah, thank you. There's honestly some really cool stuff that you can do with 1031 exchanges that people don't even realize that you can do. And you're exactly right. I mean, our last project, Coyote Creek, we had 6 1031 exchange investors on that project. They get treated just like a regular investor. And really, for all intents and purposes, everything that is going on with them is the same as a regular investor. They get treated the same. They get the same distribution rates. Yeah, so good point. That's really cool. Okay, looks like we're starting to get questions. Remember, if you got questions, you got that Q&A box at the bottom of your tab. Go ahead, click in there, type your question. We're going to answer them. So I'll go ahead and read this first question. So if the replacement property is less, say half, than the relinquished property, is this process still worth it? So I'll go ahead and answer this and let Ken add anything he wants after the fact. Yeah. In my opinion, it all depends, but I would say most of the time, yes. That's what I would do. I would still do it. I'm a CPA by trade. I love my country, but I have a right to pay the least amount of taxes as legally possible. So I would still do it. There's minimal cost to doing a 1031 exchange. Maybe if you didn't have any taxes you had to pay and the difference was, $1,000, okay, then maybe you wouldn't do it then. But almost always, you're still going to have $5,000-$10,000 worth of taxes to save on a project when you do the 1031 exchange, even if the replacement property is less, because you're still going to save a portion of that. So if you're going to buy a replacement property anyway, and even if it's half, you might as well still do a 1031 exchange for the amount that you can. You got any other thoughts on that, Ken?
Yeah, I've got a couple. First, the exchange fees usually in these transactions run $500 to $750. So depending on the size of the transaction that you're doing, that may have a bearing on whether or not you want to pay that fee. But on all tax-deferred exchanges, Mike went through that one slide that had an adjusted basis, and you carry that adjusted basis from your old property to your new property, and that then becomes the basis for your new deal. So depending on how much depreciation you want to have, and if you want to have a higher basis in the property so that you can depreciate more, or you don't want to have any restrictions on the property in that regard, you may not want to do a 1031, but if it's a fairly large transaction and you're saving thousands of dollars or deferring thousands of dollars in depreciation recapture and capital gains taxes, then it would likely be worth it just from the time value of money. You're investing more and that property gets to appreciate in value. So
Perfect, thanks. Okay, we're going to go to the next question. All right. BINA. I apologize. I'm going to tell you right now, I apologize if I say your name right. It's either Bina or Bina. Once again, I apologize. So they asked if the seller carries a loan on a sale of his property, which is free and clear, what portion of the sale is taxable other than the interest that he receives on his carryback loan? Ken, you wanna handle that one?
So if the seller carries a loan on the sale of his property, and which is free and clear, so that's saying to me that that when you're buying a property, you're taking your relinquished property and you're transferring into this new property that's probably more money, and it's so you're putting all of your investment capital that you got from the old one into the new one, and it's so big that you also have to carry back a loan, whether you get it from a bank or whether the seller carries back the loan. That really doesn't matter. A loan is a loan. But when you say what portion of the sale is taxable other than the interest that is received on the carryback loan, that confuses me a little bit, because if you're the one that is buying the property with seller carryback financing, you qualify for your 1031 exchange. If you're on the other side of that ledger and you're selling a property and to somebody else that's doing a 1031, well, it's a normal transaction for you. You have capital gains taxes, you have depreciation recapture, and any interest that's received on that carryback loan is considered ordinary income. So that's the way I'd handle it. Bina, if you want to be more maybe explicit, maybe I can drill down a little bit more. So
all right. Hey, it looks like she I am so sorry, Bina. It looks like they followed it up. So let me go ahead and read this next one, and then we're going to get to all these other questions. I see you, Diana, Richard, Jonathan. We're getting to you, I promise. So Bina, question is, the seller in this case does not exchange the property.
Yeah, so if the seller doesn't exchange the property, they're subject to depreciation recapture. They're subject to the payment of capital gains tax if they've held the asset for more than a year and a day. Otherwise, it'd be a short-term capital gain, and that's ordinary income taxes. So that's the way I would respond to that.
Oh, great. Thank you. All right, going on to the next one, Diana. So regarding the deed, can you do a 1031 if the old property has the father and son's names and the new property will only be in the son's name?
Yeah, so I want to answer that question with a yes and a maybe, or a maybe and a yes. So if the father and the son are names on the old property, and the father doesn't want to do a 1031, but the son does want to do a 1031, then they basically have the opportunity that the father can go his way and the son can do his 1031 and put it in his name. That's a good question for a qualified intermediary to make sure that that's handled appropriately. But not every partner in a real estate investment property needs to go into the new 1031. So in that case, yes, it's likely that if the son's name is on title on both, then he can move forward with that.
Great, thanks. So moving on, Richard. I am interested in the purchase of land now that over the next 2 years will be built out and become my new primary residence. I will be using 401k stock funds to purchase the land and build out the home. At the time I move in, I will put my current home on the market. It appears a 1031 is not an option.
Richard, that's a good point. That's because the couple reasons. First of all, the land that you're purchasing is not held for investment. And so if your intent, and it's all based on intent, if your intent is to hold that piece of land to build a new primary residence on, doesn't qualify. The fact that you're using 401k stock funds to purchase the land and build out the home really doesn't have any bearing when it comes to a 1031. You're welcome to do that if you, depending on your situation. Obviously, if you've got a traditional 401k, which means you got a deduction when you contributed the money in originally, any money that you take out to go to purchase the land and build a home, you're going to wind up paying ordinary income taxes on that because it comes out that way. Unless you put those dollars in as Roth after-tax dollars, in which case then you don't have any taxes and they come out tax-free. But yeah, I'm sorry, but I don't think you can do a 1031 on that.
Let me follow that up with one other quick question, kind of related. So that's assuming, right, that Richard sells his current home and uses all of that money to go into his new home, right? Then he can't. That's the transaction. He can't do a 1031. If he were to sell his house and use some of that towards an investment property, say he sold his house for $500,000 and $400,000 went to a new home, could he take $100,000 and go do a 1031 exchange? Or could he sell his house and take all the money and go put it in an investment property and do a 1031 exchange? Or is that off the table as well?
That's off the table as well, because both the relinquished property and the replacement property have to be held for investment. That's the key. And so if he's selling a single family residence that it was his primary residence, wasn't held for investment, and he's trying to then take money and buy a new investment property that is held for investment, that doesn't qualify. He can take that money, and there's residential exemptions with that are available through tax law, but he can take the money on that or a portion of the money, and if he wants to invest it into a new real estate investment, no problem. He can go in and do that. Doesn't have to do a 1031 in that case.
Great. Thank you. All right, Jonathan, can you share this presentation or at least a screenshot of the calculations of all of the savings of doing a 1031 exchange? Thank you. Jonathan, you better believe it, we can. So we will actually send this webinar out, and a replay of the entire webinar will be sent to everybody via email probably. But also this webinar is going to get posted to Overland Capital Corp, CORP.com. So if at any time you lose the email, you have a friend that's asking you questions, you can go ahead, just say, hey, go to overlandcorp.com, go to the education tab, and within 48 hours, boom, this webinar will be here. You or anyone else that you know can go in and view it. So absolutely.
Hey, but Jonathan, if you want to give us a donation, we're always, well, Mike probably doesn't want that. You'd have to send that personally to me, but I'll accept donations if you'd rather pay some money or have it for free.
What?
Just kidding. I'm just kidding.
Okay. All right. Took me a second to realize where we were going with that one. Okay. So no, this is free. We don't even think about it. Okay. That looks like all the questions. So we are going to go ahead, wrap it up, let everyone get out of here. Once again, if you have questions, go ahead and email us. Our email is there, investors@overlandcorp.com. Make sure you take the poll if you haven't done that. We'd love to get to know you better and understand who you are, what your situation is. You can also call us anytime. But overall, we had a great experience. Hope you guys learned something from this. And really that you have the confidence to go ahead and have some intelligent discussions about 1031 exchanges in the future.
Yeah, and if you have any questions, give us a call. We'd be happy to help you through the process.
Exactly. Okay, thanks everyone. Have a good day.